Late-stage credit delinquencies are increasing across all credit tiers. That increase has been driven by some big-ticket items like auto loans and mortgages, and the average VantageScore credit score is down to 701. Those are the insights we'll be talking about today on CreditGauge Live. I'm your host, Ola Fadahunsi, Head of Communications for VantageScore. I'm filling in for Jeff Richardson. I'm joined today by my colleagues, Susan Fahy and Atif Mirza. And my first question is for you, Atif. How are overall credit scores trending this month?
Thank you, Ola. In July 2025, the average VantageScore 4.0 credit score dropped to 701, which is a 1-point drop, but tells us a big story. What we're seeing is the shift in population distribution. More consumers are moving into subprime, which shows us the repayment challenges in that sector. The prime segment in past 2 years shrunk about 1.4%. And again, more consumers we see moving into subprime. A big factor, and we published this story early this year, is the student loan repayment pressures, which are weighing in on consumer credit performance.
And Susan, are there any products showing notable increases in delinquencies?
So this month, delinquencies rose for both mortgages and auto loans. Year over year across all products, mortgage and auto loans saw the largest increase in early stage delinquencies when compared to the same period last year. Mortgages, the delinquency rate rose 0.11%, and auto loans were up 0.05. When we look at the data from month over month, auto loan and mortgage balances continued to inch higher, while originations were down for auto loans and relatively flat for mortgages.
And following up on that point, what's the latest with originations?
What our CreditGauge data is showing us is that there's a divergence between secured and unsecured lending. On the secured side, we are definitely seeing a softening in new account originations. So an example is auto loans. Auto loan new account originations fell to 1.42% in July, coming off their peak of 1.76 back in April. And then for mortgages, new account originations for mortgages remain relatively flat from June to July, and they're only up slightly when you look at last year, July 2024. So that's on the secured side. On the unsecured product side, when we look at credit cards and personal loans, we're seeing an increase in new loans being extended to consumers, both month over month and year over year.
Thanks, Susan and Atif. We'll be right back with our special guest for the month, Jay Budzik, our Senior Vice President and Director of Machine Learning and Artificial Intelligence at Fifth Third Bank. And we're back and welcoming to the show Jay Budzik, Senior Vice President, Director of AI and Machine Learning Operations at Fifth Third Bank. Jay, thank you so much for joining us today.
Ola, thanks for having me.
Jay, you've got a really unusual background in that you're focused on this intersection of technology, credit, and fair lending. What role do you think credit risk modeling can play in expanding responsible access to credit?
Well, our credit scores are in use so broadly. By upgrading our credit decisioning infrastructure to rely on more accurate scores, we can both enhance the profitability of our financial institutions, ensure their safety and soundness, but also expand access to credit to people who would be overlooked by these more traditional and outdated scores.
And can you tell me a little bit more about the role that credit risk modeling is, the ways that credit risk modeling has evolved over the last decade? Sort of what trends have you seen that are shaping the future of the discipline?
Well, we have many more statistical modeling techniques than we had when the original credit scores came into the market. Some of those techniques are being used at Vantage, for example, to segment the population and to create dynamic variables that better represent consumers' credit history and allow banks and other financial institutions to make better and more accurate decisions. We also have machine learning that's entered the scene. We've seen the dramatic outcomes from upgrading our models from traditional methods to machine learning methods that we use every day, outcomes that we experience every day. When our car reminds us to stay in the lane, when Siri transcribes what we say, And those same technologies can be used to make better credit decisions. So we're starting to see those deployed more broadly in the industry.
So, Jay, how has the role of credit risk modeling sort of evolved over the last decade? And what trends are you seeing that are shaping the future of the discipline?
Yeah, so we have many more statistical modeling techniques today than we had 10 years ago or when the first credit scores entered the market. Some of those techniques are in use at VantageScore that enable banks to make more accurate and fair credit decisions. But we're seeing folks evolve even further to use machine learning in their modeling practices. That same types of techniques that are used to transcribe your voice when you speak to Siri or to help you keep in the lane when you're driving your car. Those enhanced modeling techniques can be used to make more accurate decisions and also to improve fairness.
That is so interesting. Can you tell us about some of the best practices for balancing these types of innovations in modeling techniques with the needs for strong governance, if you will?
Yeah, I think the main issue with those types of models, the machine learning models, the AI models, is transparency. And in the United States, we have laws that require us to explain to consumers whenever we deny an application or if we reduce the line that they have access to. And those requirements really mandate that we have transparency in how our models operate and how decisions are made. And that's been historically been a challenge for machine learning as a field. It certainly is a challenge with the large language models that we're seeing today. But the techniques that are used in credit decisioning have evolved to the point where we can now accurately explain outcomes. We can look at which factors are driving decisions the most, and we can interrogate the model to ensure that the decisions that it would drive are intuitive and understandable.
In your role at Fifth Third, I'm sure you're looking at all sorts of key indicators of consumer credit health. What exactly do you look for, and what's your overall viewpoint on the credit health of the consumer for the remainder of this year?
We look at a number of things. We look at how our consumers are performing in our own products. Are they repaying on time? Are they paying more than the required amount? We also look very closely at consumer deposit data because it's just such a clear indicator of the financial health of a consumer, how much they're making, how much they're saving, and how much they're spending. So those data are our first stop, shall we say. Then we look at the broader market. We look at what's happening more globally with delinquencies, what's happening in housing, employment, more of these sort of economic indicators. And what we see is that some of the card balances are growing a little bit. But we haven't seen any tick up in delinquencies, which seems to indicate resilience. And despite all of the uncertainty related to the tariffs and the economic policies, the consumers do seem to be maintaining this resilience. So we're cautious because of the uncertainty caused by the broader economy, but think that the consumers are in relatively good shape and will continue to be so through the rest of the year.
Jay, thank you so much for sharing those insights with us today. We want to thank you for joining us for this month's edition of CreditGauge Live. Once again, please visit us at VantageScore.com to learn more about the latest on consumer credit health trends. We'll see you next month.